All right, so it is Tuesday, February 3rd, 2026. The Q4 numbers for Grainger are out, and, well, the market's reaction is telling us a very specific story about the industrial economy.
It really is. It's telling us that, quality just creates its own gravity. We're looking at a company that is somehow managing to decouple itself from this broader macroeconomic malaise.
Grainger, that's ticker GWW for those of you tracking at home, has always been this ultimate bellwether. I mean, for decades. If you want to know if factories are humming or stalling, you check Grainger's pulse.
Exactly.
But this morning's release, it creates a bit of a paradox. You've got this legacy industrial giant navigating a flat to negative market, but the stock is just ripping upwards. It closed today at $1,156.44.
Which is a huge move.
Yeah, that's up 5.5%, $60 a share.
A massive move for a company of this size. And it's not just about the last quarter, it's the forward guidance. I mean, they're projecting a level of confidence that, frankly, you just don't see in the rest of the industrial sector right now.
Okay, let's get into the actual numbers first, because while the stock move was loud, the beat itself was actually pretty disciplined. They reported EPS of $9.44 against a consensus of $9.43.
So a one-penny beat.
Right. You do not get a 5% rally on a one-penny beat. Now, the revenue story was a bit stronger, $4.43 billion versus the $4.39 billion expected. But the real story here has to be the guidance for 2026.
That is exactly it. Management is calling their outlook constructive, which, is the polite corporate way of saying they intend to steamroll the competition. They're guiding for 2026 revenue between $18.7 and $19.1 billion. But look at the daily organic constant currency growth projection, 6.5% to 9%.
That 9% at the top end, that's the anomaly. We really need to put that in context right away, because D.G. McPherson and the team were very, very clear about the environment they're in. They're not predicting some economic boom.
Far from it. And that right there, that's the central tension of this whole report. Grainger is forecasting their own growth at nearly double digits, while at the same time modeling the MRO market maintenance, repair, and operations to be down 1.5% to flat.
So the pie is shrinking, but they're planning to take a much, much larger slice.
Aggressive market share consolidation. That's the only way the math can possibly work. I mean, if the tide is going out and your boat is rising, it just means you're taking water from someone else's pool.
Let's talk about how they're measuring that tide, because this was, for me, probably the most intellectually interesting part of the whole earnings call.
Oh, for sure.
For years, the industry standard for forecasting demand has been, the IP benchmarks industrial production data from the government and the big banks.
Right, the single factor model. If industrial production goes up, MRO consumption goes up. And that correlation was reliable for 40 years.
But that correlation broke.
It completely shattered post-pandemic. We saw this divergence start way back in late 2023. The IP numbers were showing a recovery, suggesting factories are cranking out goods. But Grainger's actual sales data, the ground truth, was showing softness. The map just didn't match the territory anymore.
So instead of following a broken map, they built a new one. They spent the last 2 years developing this proprietary multi-factor model.
And this isn't just, a little spreadsheet tweak. They're tracking over 1,000 economic indicators now. They aren't just looking at production output. They're weighing supply and demand, capital goods shipments, export-import dynamics, even labor utilization rates.
It almost sounds like they built an internal hedge fund model just so they could sell safety vests.
In a way, they kind of did. And the result of that new model is what drove their 2026 outlook. The standard IP model might still show some false optimism, but Grainger's multi-factor model says the MRO market is actually contracting down about 0.5% to 1.5%.
Which feels like a really bold move to stand up and tell Wall Street, hey, the government's data is wrong, our data is right, and by the way, based on our pessimistic market view, we're going to grow 9%.
It's confident, it's bordering on arrogant, really, but their track record kind of earns them that right. By acknowledging the market is actually down, they can allocate capital more efficiently. If you think the market is growing when it's not, you overspend on inventory, on labor. Grainger is positioning for a grind, which makes their margin targets all the more impressive.
Speaking of margins and the grind, we have to split this company apart. Grainger isn't a monolith. It's really two different businesses operating under one roof. You've got the high-touch solutions here in North America.
Yep.
And then the endless assortment model with Zorro and Monte Carlo.
And the performance difference between them in Q4 is just stark.
Let's look at high-touch first. This is the legacy business. The sales reps, the relationships, getting technical parts to a factory floor in Ohio. Growth here was sluggish.
Very sluggish. Daily sales up just 2.1% in constant currency. But the concern here wasn't just the top line, it was the profitability. Operating margins in the high-touch segment, they compressed significantly down 120 basis points to 15.8%.
And we can't just gloss over that. A 120 basis point drop for a mature business is a real hit. The narrative was higher SG&A, but there were some specific gremlins in the quarter.
Healthcare costs were the main culprit. They saw this spike in claims that went well above the normal run rate. And that's a kind of volatility you can't really hedge against. But there's also the issue of the government shutdown and lapping the hurricane.
Right, lapping that hurricane benefit from the prior year makes the year-over-year comparison look worse than it really is. But even if you strip that out, high touch just feels expensive to run right now.
It is expensive. I mean, that's the nature of high touch. You have the sales coverage, technical support, physical branches. When volume slows down, that fixed cost base really bites you. They did, however, note strong performance with contractors and manufacturing customers, so the core portfolio isn't rotting, it's just facing some headwinds.
Now, contrast that with the endless assortment segment. This is the digital-first, low-touch model. Zorro in the U.S., Monotaro in Japan. And this part of the business is absolutely flying.
It is the growth engine, plain and simple. Daily organic sales up 15.7%. And unlike the high-touch segment, margins here actually expanded up 200 basis points to 10.6%.
That 15.7% growth is just incredible in a flat economy. Zorro U.S. was up 16%. And they're starting to pull levers that we usually see in retail-like private label products.
Which is a huge margin unlock for them. I mean, if you can sell a Zorro-branded tool instead of a third-party brand, you capture all that extra margin. Plus, they're seeing better repeat purchase rates from their B2B customers.
Monotaro in Japan was up 18.4%. But there's a little bit of a black swan story there with a competitor, isn't there?
Yes, the cyber outage. A major competitor in the Japanese market suffered a really significant cyber attack that basically took them offline.
That is the modern business reality, right?
Yeah.
Your competitor gets hacked, and your web traffic just doubles overnight.
It provided a very clear tailwind, and Grainger capitalized on it well. But we do need to discuss the mixed headwind this whole thing creates for the total company.
Right, because high touch has operating margins of almost 16%, and endless assortment is around 10.6%. So if the lower margin business grows way faster, the overall company margin percentage has to drop.
Exactly. It looks bad on a percentage basis. It dilutes the gross margin.
Right.
But management was very, very firm on this. They care about profit dollars, not profit percentages. If endless assortment brings in a bucket of cash, they will happily take that percentage hit.
We pay our dividends in dollars, not percentages.
Precisely. It's a good problem to have.
Okay, let's zoom out to the macro factors, because 2026 isn't going to be a walk in the park. We have the tariff situation, which is fluid, to say the least.
Tariffs are the elephant in the room for any industrial importer. Grainger has passed through most known tariff costs already. They took pricing actions back in November and then again just last month in January.
But there's a mechanics issue here with LIFO accounting last in, first out.
There is. When tariffs hit, the cost of your newest inventory just jumps. Under LIFO, you have to record those higher costs immediately against your revenue, even if you're physically selling the older, cheaper stock.
So your cost of goods sold spikes before your price increases can fully catch up.
Correct. It creates this temporary margin squeeze. We saw that in Q4, and they warned it's going to bleed into Q1 of 2026. The goal is price-cost neutrality over time, but that timing mismatch is painful in the short term.
And on top of that, the tax man is taking a bigger cut. The effective tax rate is jumping to about 25% this year.
Up 130 basis points. That's a direct hit to the bottom line because of federal tax law changes and, the expiration of some one-time benefits. So Grainger has to grow earnings by more than 10% just to stand still after taxes.
Which explains the focus on efficiency. They also cleaned house in the UK, divesting Cromwell and shutting down Zorro UK.
That was long overdue. The UK market has been a drag on their portfolio for years. Exiting those businesses provides a 45 basis point tailwind to operating margins in 2026. It's a classic case of addition by subtraction. Just stop throwing good money after bad.
Let's pivot to the future then. How do they actually achieve that 400 to 500 basis points of outgrowth above the market?
Yeah.
T.G. McPherson laid out 5 strategic growth engines, and a lot of it centered on technology.
It really did. And not just tech for tech's sake. This is about operationalizing data. Take the seller coverage and seller effectiveness engines.
So they added 110 new sellers in 2025. But they're arming them with this seller insights platform.
And this is where the AI buzzword actually hits the pavement. In 2026, they are integrating AI into that platform to tell the sales rep exactly who to call and why.
So instead of a rep just staring at a spreadsheet, guessing which factory manager might need new filters, the system literally says, Client X is 3 weeks overdue for a reorder based on their usage patterns.
Exactly that. Or it identifies a contact at a subsidiary they didn't even know existed. It changes the sales role from hunting to executing. It just increases the revenue per salesperson so much.
They're also applying machine learning to their marketing spend.
At the SKU level, this is critical. They're not just buying ads for Grainger. They're using algorithms to calculate the customer lifetime value and the availability of specific products to decide if they should bid on a keyword for one specific drill bit.
It's like high-frequency trading, but for industrial marketing.
That's a great analogy. And it optimizes their spend so they aren't wasting marketing dollars on low margin or, out-of-stock items.
But you still have to move the box. And the supply chain investments here are massive. We have the Northwest DC in Portland coming online and a new inbound facility in Houston in 2027.
And the Mito DC in Japan for Monotaro, which opens in 2028, that facility alone will nearly double their shipping capacity there. These are physical moats. You can write code in a garage, but you cannot build a 1 million square foot automated distribution center in a garage.
This brings us to the money. Capital allocation. They're expecting operating cash flow of, $2.1 to $2.3 billion. They're spending about $600 billion on CapEx, these warehouses we just mentioned.
Yeah.
But they are also planning $1 billion in share buybacks.
Which is a significant commitment to their own equity.
Is the best use of cash, though? With the market potentially softening, shouldn't they be keeping some dry powder for acquisitions?
It's a fair debate. But look at valuations. Buying other companies is expensive right now. Grainger's management clearly believes their own stock, even at over $1,100, is undervalued relative to their growth plan. $1 billion buyback plus a double-digit dividend increase tells me they just don't see any massive M&A targets that are more attractive than investing in themselves.
It signals extreme confidence in that 2026 plan. They are effectively betting $1 billion that they're going to hit that growth target.
And that they will navigate the tariff situation successfully.
So if we put this all together, Grainger beat Q4, but the real story is they've built a proprietary economic model that says the world is shrinking, yet they plan to grow nearly 10% by stealing market share through superior data and logistics.
That's the thesis. In a fragmented, difficult economy, scale and information are the winning leverage points. The local distributor cannot compete with Grainger's AI-driven marketing or their automated supply chain. The gap between the haves and the have-nots in the industrial sector is just getting wider.
It's a consolidation story.
It is. Grainger is becoming the Amazon of the industrial world, not just in its size, but in its data sophistication.
I want to circle back to that multi-factor model one last time before we close, because it just keeps nagging at me.
It is the most lingering detail of the entire report.
Think about the implication.
Yeah.
Grainger, a boring industrial supplier, essentially decided that the Federal Reserve, the Bureau of Economic Analysis, and all the major banks were producing data that it was useless for real-world decision-making.
It implies a breakdown in our shared economic reality. The traditional metrics, IP, GDP, they might be measuring an economy that just doesn't exist in the way we think it does anymore.
So if a company that sells bolts and motors has to build its own economic engine just to understand what's actually happening, what does that say about the rest of us who are relying on the standard headlines?
It suggests we might all be flying blind, or at least flying with instruments that haven't been calibrated since 2019.
If the map is wrong, the person who draws their own map wins. Grainger drew their own map.
And 2026 will prove if it leads to the treasure.
We will be watching. That's it for this deep dive on WW Grainger. Check your own models, and we'll see you next time.